Hello, welcome back. As the Nasdaq keeps doing its thing and going down, I want to examine some companies that I long wanted to hold and I haven't gotten a chance really to get them at a decent price. Now, Apple is a company that I have traded a lot in the past. I have held it for a few months, then sold it, and I never really hold it for the long term because it was, generally speaking, a little bit expensive for what I wanted. Now, as it's going down, this may be a prime opportunity to potentially buy a little bit of Apple. And I wanted to explain some very key points here in terms of what Apple is doing financially, because people may be seeing some metrics here and they may look awesome, but they may not really understand what is going on and why this is happening. So, let's first start off with the P ratio of the company, which is sitting at 27.8 right now, and it's doing better than what it used to be. Now, this is a little bit elevated, but not much when we talk about a company like Apple, which is generating tons of money and it has great return on equity and things of that sort. We're gonna examine this and I'm gonna explain, but I don't just necessarily go off the P ratio. That's not enough. And the price to free cash flow ratio is a little bit better, but as you see, it's very close to this one. Again, we cannot really deduce whether that's a good buy for sure over here. Now, the thing that I really like is the outstanding shares going down because the Apple is buying back shares like crazy. It looks like 5 years at 22% down in terms of their outstanding shares count. That's amazing to see, and I think this will continue happening. So that's a very, very a good extra here and a very, very plus sign. Now, the free cash flow to total liabilities is a metric that I really like because it tells me how many years of last year's free cash flow it would take for the company to pay all their total liabilities. And as you can imagine, especially if we have a debt leveraged company which has a lot of liabilities, this number being low is a very, very good sign of solvency. And so this is very important to know because now we know that Apple can very, very easily and quickly pay off their debt if they had to, paying not only their debt, basically their total liabilities. So that's a very good thing. Now, before I jump into this here, you will see the debt. The debt to equity ratio is rather high. You're spotting this. You're thinking, okay, debt is high compared to equity. Why is that the thing? So why is that happening? Shouldn't we be having larger equity than debt? Well, not really, not necessarily, especially with a company like Apple. And let me show you why this is happening so that you can understand the whole story behind what Apple is doing. And this kind of figures here can pretty much tell you a story even if you don't know the story. Because when I'm looking to make a video, I'm looking at these figures and I'm like, okay, why is this happening? Then I research why this is happening and it makes a ton of sense. Again, if you understand a little bit of the financials, and the key metrics and how they work, but I'm going to be explaining this as we go. So we have a debt to equity ratio that is rather high here, meaning that the company has a lot of debt when you compare it to equity. Now, if you take a look at this article here, it can kind of help you understand Apple's capital structure. I'm not going to go too deep with this one, but what I wanted to show you is this here. The second component of a company's capital structure is debt, of course, representing how much the company owes to creditors. Apple's liabilities were 310 billion over here, consisting of the billions, 54 billions in accounts payable and total current liability amount of 125 billion. But take a look at this thing. Due to zero interest rate policy environment, Apple began issuing its first bonds and notes in 2013. And basically, this is debt, this is loans, underwriting a total of 64 billion worth of debt. Apple made this move because it needed not because it needed the capital, of course, but because it was essentially receiving free money. And with much of Apple's bonds having nominal interest rates of less than 3%, the real returns of these instruments barely beat inflation. However, the accumulation of debt by Apple has changed its capital structure considerably. And so this actually tells you that the company has been getting long-term debt, quite some debt, and has been increasing its debt. It kind of also tells you that the company's debt to equity ratio has grown, as we already examined here. And this happens because Apple is actually using debt leverage to increase their equity, their return on equity, that is. And look at this one here. A return on equity is 149.8%. This sounds great, but what is it? What does that mean, really? So return on equity, let's break it down. Return on equity is about the net income that the company generates. So let's go to our net income statement here and let's examine that. What was that last year? So Apple actually generated 94.6 billion in terms of their profit last year. That is profit after taxes, right? Net income. So 94.68 billion is what they generated. And let's now take a look at their balance sheet. Now their balance sheet points us to total equity of 63.09 billion. And so now we're going to be using our calculator here, and that's 63.9. So let's go back and check it. Check the income statement again. And it was 94.68 divided. So we divide the net income that the company generated to the total equity that the company has. That's the total stockholders' equity, divided by 63.09 over here, 63.09. And this gives us about 150%, 1.5 here is what you're seeing on the tool, pretty much. A little bit rounded, of course, but it's that's the same value. Let's go back. So 149.8. So what does that value tell us? So this value tells us how efficient the company is in using the assets that it has, the total assets that it has. That's the total equity that it has. That's total assets minus total liabilities. How efficient they are at using this asset to generate profit, to generate net income. And it looks like in this case they are super efficient, of course, because they are returning 150% on the total equity that the company has, which means that you are getting a great return on equity if you are investing in Apple. Now there is a little bit of a problem here, and a reason why this number is actually very elevated. And that reason is debt. This happens because Apple is using a lot of debt to generate this equity. And remember what the formula was, right? The formula was net income divided by, let's go back again so that you can understand what I'm talking about. So it was net income divided by total equity, which is what? Total assets minus total liabilities is what total equity is. And so as you can understand, if this number is low, the lower it is, then the higher return on equity we're getting if the net income is high, of course. And so what does that mean practically speaking? If we get more debt, if the company increases its liabilities by getting more debt and pretty much reduces the total equity, which, wait, this is happening here, right? So if that happens, then we are increasing our return on equity because we are deploying debt in order to create that return on equity. And as you can understand, if a company has, let's say $10,000 in equity and $1 million in debt, then they can use this money with an interest of 4%. And if this is a capital of $1 million 10 pretty much. And if they generate 10% return the next year, then they have generated $100,000. And so this return on equity is amazing because it's insane. It's like they're having almost no equity and they are practically multiplying it by multiple times, as you can understand. And so the return would be much different if they were using just equity and not debt. And so by utilizing debt and just paying a little bit of interest, they can effectively double, triple, quadruple their initial equity very quickly just by using this debt leverage, if their operations are doing well, of course, and if they can do that. So while this number is crucial for companies, it can be a little bit deceiving at times, and you see a high number and you may be thinking why that's the case and why this is happening, why it's that high. And so I wanted to actually take the time. Maybe this video is going to be a little bit longer, but I think it's crucial to understand how this works. And this is now you know why this debt to equity ratio is high and why Apple is using insane debt leverage here, which of course is not a bad thing at all, but it's worth understanding what's going on here with the company. Now, we kind of talked about this, and I think this was a fair topic to understand, a very useful topic to understand. And so, generally speaking, the financials of Apple are great, but what's happening with the revenue growth, the net income margin, and the free cash flow margin, and how can we utilize those to project what we want to be paying for the company today? So, the revenue growth of the company has been kind of the same, although last year was amazing. Totally amazing. Of course, we cannot and will not go that far because the company won't be growing at that rate. It's a massive company. We can't expect it to be growing its revenues at 33% a year. That's not going to happen. So we're probably looking at these numbers, and this may even be confident, again, for a company of that size. Let's just try that though. So the net income margin here, is pretty much almost the same every year. Another great thing to see from companies that are steady in their financials. And free cash flow margins, again, look at these numbers, amazing, just amazing. I absolutely love when I see that. This is actually, let me go 95 here. This is awesome because I know exactly what to aim for, and I'm likely going to be very close. So to what I'm getting, annual return of 13%, I want to be getting a little bit extra because I can get 10% from an ETF, S&P 500 ETF. And when I hit calculate, you will notice that we are far from what I would want to get Apple for. Now, I would potentially be willing to even take it at a high level here because the company has, again, pretty nice returns. They are doing very well, great margins, very, very solvent company, lots of free cash flow. I mean, there are tons of good things here. So I would potentially even be willing to be around these levels, while normally I go low and medium. In this case, I think I would be willing to be somewhere in between. So maybe 95 to 100 would probably be a price that I would be willing to pay for Apple. But I'm not willing to pay this current price. I think it's a little bit expensive for what I'm getting. I get a fantastic company, but a solid investment is about the financials, and the price of the stock, the current market price. They have to combine well. They have to align for us to make sense to actually enter the company and get some stock. And now you know why this equity is growing, right? The total equity is growing. It's actually shrinking over here. Now you understand this is because of debt that the company receives. And frankly speaking, I'll probably do the same. It actually helps that you point this number to investors, and you're like, look at us. We're generating 150% return on equity. Okay, so I hope the video helps a little bit. I hope it gives you some ideas and it was useful to you. Please leave a like if you did enjoy watching this one, and remember to subscribe. We'd love to have you around, and thank you for watching this one. Again, I'll see you soon. In the meantime, take a look at the video that I made earlier. It's about PayPal and what they are doing. They are looking like an interesting opportunity potentially. So thanks for watching again. See you soon, guys. Bye-bye.